You're not going to believe this, but what just happened could quietly hit your wallet harder than inflation ever did. Because Donald Trump just made a move that many experts are calling a war on oil. And whether you invest or not, whether you follow politics or avoid it completely, this could change how much you pay for gas, groceries, electricity, even rent. And the craziest part? Most people don't even realize what's coming. So today, I'm breaking it all down in the simplest way possible. What's actually happening, why it matters, and most importantly, what it means for your money. Because this isn't just politics. This is personal finance. Let's get into it. So here's the situation. Trump has been doubling down on aggressive energy policies that prioritize American oil production, pushing hard against global oil alliances and regulations that limit drilling. On the surface, that might sound like a good thing, right? More oil means lower prices, but here's where things get complicated, because when people say war on oil, they don't mean he's trying to eliminate oil. They mean he's disrupting the global oil balance. And oil isn't just about gas for your car. Oil is deeply connected to almost everything in the economy: transportation, manufacturing, food production, shipping, even the price of your favorite products at the store. So when there's tension or disruption in the oil market, it sends shockwaves everywhere. And right now, that's exactly what's happening. Let me explain it in a way that actually makes sense. The global oil market works like a delicate balance between supply and demand. Countries like Saudi Arabia, Russia, and the US all play a role in controlling how much oil is produced. When supply is tight, prices go up. When supply increases, prices usually fall. But here's the catch. When one major player, like the United States, starts making aggressive moves to dominate oil production or ignore international coordination, it can trigger reactions from other countries. And those reactions can get messy. We're talking about potential price wars, sudden supply cuts, and unpredictable spikes. So instead of oil getting cheaper and staying stable, it becomes volatile. And volatility is what hurts everyday people the most. Because when prices swing wildly, businesses don't know how to plan. So they raise prices just to protect themselves. And guess who ends up paying for that? You. Now you might be thinking, okay, but how does this actually hit my money? Let's break it down. First, gas prices. This is the most obvious one. If oil markets become unstable, gas prices can spike suddenly, even if they were low just weeks before. And once prices go up, they don't always come back down quickly. So your daily commute? More expensive. Your travel plans? More expensive. Even Uber rides? Yep, more expensive. But it doesn't stop there. Because higher oil prices increase transportation costs for everything. Food has to be shipped, clothes have to be delivered, raw materials have to be transported to factories. So when oil prices rise, businesses pass those costs on to consumers, which means your grocery bill quietly creeps up. Your online orders cost more, and suddenly, your monthly expenses feel heavier, even if your income hasn't changed. Now here's something most people don't realize. Energy policy doesn't just affect prices, it also affects jobs and investments. When there's a push for aggressive oil production, companies in the energy sector can boom. Oil companies, drilling companies, pipeline operators, they all benefit. But at the same time, it can hurt investments in renewable energy. And this creates a split market. Some sectors rise, others fall. So if you're investing, even casually through retirement accounts, this kind of shift can impact your portfolio without you even noticing. Your index funds, your ETFs, your pension, they're all tied into the system. And when one major sector becomes unstable, it creates ripple effects. Now let's talk about inflation, because this is where things get really serious. Oil is one of the biggest drivers of inflation. When oil prices go up, everything becomes more expensive, and central banks, like the Federal Reserve, pay very close attention to that. If inflation rises too fast, they may keep interest rates higher for longer. And what does that mean for you? Higher mortgage rates, higher credit card interest, more expensive loans. Basically, borrowing money becomes more expensive across the board. So even if you're not directly buying oil, you're still paying for it in other ways. Now here's the part that might surprise you the most. Even if Trump's policies lead to increased oil production in the US, that doesn't guarantee cheaper prices for Americans. Why? Because oil is a global commodity. It's priced on the international market. So even if the US produces more oil, companies can still sell it overseas where prices are higher, which means domestic supply doesn't always translate to domestic savings. And that's something a lot of people misunderstand. So you could have more oil being produced and still be paying high prices at the pump. Crazy, right? Now let's zoom out for a second, because this isn't just about short-term price changes. This is about long-term economic shifts. If this war on oil escalates into global tension, we could see major changes in how countries trade energy. New alliances could form, old agreements could break, and markets could become more unpredictable. And when markets become unpredictable, investors become cautious. Businesses slow down spending, hiring can freeze, and economic growth can take a hit. Which again, circles back to your money, because slower growth can mean fewer job opportunities, lower wage growth, and tighter financial conditions overall. Now, I don't want to make this sound all doom and gloom, because with every major shift, there are also opportunities, and smart money always looks for opportunities. For example, if oil companies benefit from these policies, their stocks could perform well. Energy-related industries could see growth, and certain regions that rely on oil production could experience economic boosts. But here's the key. You have to be aware of what's happening, because the worst place to be during a financial shift like this is completely unaware. Most people only react after prices rise, after markets move, after it's already too late. But you're here, learning about it before it fully plays out, and that gives you an advantage. So what should you actually do? First, pay attention to your expenses. If energy prices start rising, look at ways to reduce unnecessary costs early, before it adds up. Second, stay aware of market trends. You don't need to be a full-time investor, but understanding which sectors are gaining or losing can help you make smarter decisions. And third, think long-term, because these kinds of shifts don't just last weeks or months, they can shape the economy for years. So positioning yourself early, whether that's saving more, investing smarter, or simply being cautious with spending, can make a huge difference. At the end of the day, this isn't just about Trump or oil or politics. It's about how global decisions trickle down into your everyday life, your bills, your savings, your future. And the more you understand that connection, the more control you have over your money. Because while you can't control global markets, you can control how you respond to them. And that's where real financial power comes from. So keep your eyes open, stay informed, and don't underestimate how something that sounds distant can hit very close to home. If you found this helpful, make sure you stick around, because I break down complex money topics just like this in a way that actually makes sense. And trust me, the next shift is always closer than you think.